Hi, good morning, everyone. Oh, good afternoon for most of us, actually. Sorry. But yeah, let's give it a few more seconds for people to join in and we'll get started very soon. Okay, maybe we should kick off now. Hello, everyone, again, and welcome to this webinar. Thank you for joining us today. This week we have launched our quarterly outlook, which we will be discussing today. I'm Charu Chanana, a market strategist with Saxo Singapore, and with me today are two of my colleagues, Redmond Wong from Saxo's Hong Kong office and Jessica Amir from the Sydney office. I know it sounds a bit odd, that the outlook is being launched well into or actually closer to the middle of the first quarter, but the timelines with the year-end holidays, and we have another flagship publication, Outrageous Predictions. I'm sure you've had a chance to go through that. We published that at the end of the year as well, so it just gets tricky for the first quarter. But these are broadly our views for the first half of the year, and we certainly have, some very interesting themes playing out. Some carrying over from last year, but some very new ones as well. And let me also just say that this outlook is really an effort of our global team. A lot of that is obviously in our headquarters in Copenhagen, some in other parts of Europe as well, in Amsterdam and Paris, and the three of us here in Asia. So if you have some time, do look into the publication as well. It's available on our website, on our platform as well. It's a comprehensive collection of 10 chapters, and we will obviously take you through an overview of that today. So I'm just going to share my slides to start that off. Okay, I guess you can see my slides now. Yeah. Um, the title for our latest outlook is The Models Are Broken. Obviously, the first question is which models are we talking about? So, in very simple terms, the economic model, the simple equation of demand and supply, and why we think they are broken. That requires a relatively longer answer, but let's start with how the world was operating pre-pandemic. We had globalization catching up, pre 2016 at least, and the opening up of Chinese markets did allow a significant expansion in global supply of capital, in global supply of labor as well. We had cheap metals and energy flowing in from Russia, so there were overall downside pressures on inflation. But where we are now, we are in a space where there has been underinvestment in the physical world, which has put some pressures on supply chains. Supply of energy and metals to an extent, agriculture as well, is not coming as well from Russia as it was previously. So, with that physical world shrinking, and when you do fiscal easing of the size that happened during the pandemic, uh, the pressure obviously flows into inflation. So, what we're trying to say here is that inflation, from our point of view, structurally will stay higher for longer. And on top of that, you add our cyclical, view to it that growth is pretty robust this year. That is what we think. I mean, we never thought of recession being a probability. We always thought that U.S. economy could actually, really do okay this year, despite all the interest rate hikes that we've seen. But now we are actually shifting to another camp where we do think that growth can be rather strong this year as well. Europe has already skirted a recession, and with China reopening, that's obviously sending a positive impulse to the rest of global growth as well. And even domestically in the U.S., financial conditions haven't tightened as they would have in a usual Fed tightening cycle. So at that, our view of that economic growth will reaccelerate cyclically. Again, supply chains are not really fixed, so that does mean that inflation could remain elevated. And Fed rate pricing is not reflecting that as of now. It is potentially on a wrong footing and will need some correction. So the other model that we are talking about is potentially breaking is of energy infrastructure. So we transform our energy systems to kind of reduce reliance on fossil fuels and reduce our impact on the climate. But we don't have a reliable baseload infrastructure. So that does mean that, obviously we've skirted through it over last year, without Europe and Germany particularly not having the supplies from Russia. But I think it wasn't such a bad winter, so we could avoid a disastrous outcome. But this is something that, we need to work on. The global economy needs to work on securing baseload energy supplies, and then obviously still continuing to evaluate how we can try to meet the net zero goals as well. So also important to consider here that climate change, I have as one final point on this slide, and how that is making it extremely difficult to predict agricultural supply over the coming years. And again, add to that growing protectionism. You have India sometimes banning wheat, now it's sugar. So that continues to create a risk of relying too heavily on climate models and production expectations. So these are, just some of the things that we think we cannot, continue to predict things the way we used to previously, and that's why we call it the models are broken. And also, if you look at it from a very short-term perspective, from 2008 onwards, the rapid rise of digitalization that we've seen, we think that model is breaking as well. Not that we are going to go back on digitalization, but just that the kind of significant alpha that tech and digitization used to provide, that model seems to be broken as well for us. As you can see here on this chart, the intangible versus tangible assets. So for the S&P 500, so the intangibles have actually gone up from 17% in 1975 to about 90% in 2020. So we think this is completely out of balance. Coming out of the pandemic, tangible world is fighting back. Infrastructure, the commodities, and these things are coming back because of the structural shortages in supply, as we've talked before. And our sense is that tangible economy will continue to ramp up in the years ahead as well. So that's relatively a new model as well for the world economy to cope up with. Overall, what does that mean? It just means that inflation will be higher for longer because of the structural shortage of raw materials, of cheap capital, of cheap labor. So we are looking at inflation rate of about 3 to 4% over the next few years, and a combination of strong fiscal and monetary expansions interacting with supply shocks will continue to generate high inflation. No doubt it will come with a lot of volatility, but it also means that there will be a lot of productive investment. So that's probably the brighter side, and that probably also creates those investment opportunities for us. And so just coming back to the point as to what it means for the markets, like I said earlier, the Fed rate pricing is potentially on a wrong footing, especially because we still have 2 rate cuts priced in for this year. As this chart is showing, this is the 60s and the 70s, more so the 70s, I would say, when the Fed cut rates prematurely, I would say, and inflation kept coming back. So this happened 3 times before they could really bring inflation under control. So I think this time, and the Fed has also kind of hinted at the 70s era, they're just very conscious of premature easing, lest that inflation could prove stickier than expected. So I think we will need to adjust those Fed rate expectations to drive out those 2 rate cuts that are priced in for this year in our sense. Well, broadly, I think I would probably just stop here and pass over to my colleagues to run through some of the implications of this macro backdrop on different asset classes. Redmond, I think it's over to you, and maybe just I will remind you all to kind of send in your questions. You will probably find a Q&A box somewhere on your screens on the side. So I think keep sending your questions and we'll take them right at the end.
Yeah, I'm trying to share some of my screen. And yes. Okay, yeah, so coming up now. Okay, the first chart look at just to further elaborate a bit on the on what Charu you have just mentioned about the Federal Reserve, the old model. And can you see my screen now?
Wait, Edmund, you can just maximize the chart. Can you press
Yeah, okay, yeah.
F5? Yeah, yeah.
Just want to maximize it. Yeah, okay. Anyway, it's maybe we just continue like that first. And yeah, and I think the Fed throughout 2021, they are using the old model. When inflation start to go up, you look at this chart on the pink area, and that is the inflation going up, but the Fed was not doing anything. And then get to the green zone basically after March 2022, and that is the green. This is the phase that the Fed was tracing the inflation trend from behind. And then the most important point I want to focus is actually in November last year. And after the 3rd of November FOMC, and I think the Fed communicated a very clear signal that is in a inflection point, and the Fed has moved to a risk management phase. What I mean by that is they are evaluating whether they can actually go back to the old model and or actually that is something they have to do it differently. And the market actually is pricing in since then, and the Fed will be going back to using the old model and pricing that they will be cutting rates very soon this year. And the Fed now is waiting the odds, the pros and cons, and they are looking at the incoming data, and it's kind of risk management phase. And that this chart I think is important. Is since this inflection point on the November 3rd FOMC, and you can see in the green area here, you can see this chart is report the 10-year Treasury yield in inverse scale. So it's when and then when it coming down is the yield actually going higher yield, and then they plot together with the S&P 500 price chart, and then you can see actually since last year is the S&P is trading in tandem with the 10-year yield, and when you're coming down and stock come down, and when you're going up, so when you're coming down, stock going up, and then when you going up and stock coming down. And so in the green zone is when the Fed has changed from chasing the inflation trend by raising it very fast to a risk management, and then that trigger, and that actually set off a huge rally in equity since November until now. And then but one thing is these because it's now the market pricing in some 50 basis point rate cut in the second half. That I think given that the economy is still very strong here in the US, and as Saxo, we think that the US economy is still quite resilient. So we think that the Fed can probably pause after 2 more rate hikes, but at the same time, it's very difficult for them to cut, and inflation may actually pick up again and in the second half. So if the Fed is not cutting rates as the market expected, and the market may have some issues in the second half. So what our view on the US stocks mainly is in the US, in the stocks in the first quarter, and probably also in second quarter, and risk asset including stock will be doing better. And then in the second half, and that would be some maybe more bumpy. But now we move on to China, and the thing we mentioned China right after the US is because it's when there's certain headwinds there, but in China it's because of there's a big change in the reopening from the pandemic containment policy over these 2 months, and also the second thing. The Chinese authority also reverse course now supporting the real estate sector, and because it's the real estate sector in China is very important, and it's account for 25% of the GDP, and then that will be Yeah, that would be in fact is and then the Chinese and that would be actually would be very stimulative and to help the Chinese economy to grow. And then is and then the third thing, and China has been those kind of green line and red line attitude towards the private enterprises and the platform company. What it means is that when when the private enterprises become, especially the internet platform company, become very powerful, and the government crack down on them. And because now the Chinese authority now focusing on stimulating the economy and want to create more jobs, and so that is also a big change in their policy, and at least for the near term, and become much more friendly and supportive to the internet platform company. All these free domestic policy and will help to boost growth in China. And the fourth one, and you can see for China has also become more conciliatory, and including, for example, start importing coal again from Australia, and trying to tune down some of those rhetoric, and and try to improve their relationship with external trading partner. Of course, geopolitical tensions still here, and the latest one, of course, the balloon case incidents. But I mean, but those things is maybe still will be on the background. But the key thing is economic growth is much more important in consideration. So that means is now China, the reopening and all this policy to stimulate the growth in China is going to help the growth in the global economy as well. And also in that sense, will also be a positive factors, not only to the Chinese equity market, but also to the US and European equity market as well. And so overall, and also be contributing to the demand for commodities globally. And on the left-hand side, bottom column, I just cite one article from the Fed, and you say what happens in China does not stay in China. And what this research actually say, when China credit expansion and they bring about growth in China, this credit expansion and economic growth in China will spill over to the global economy. This is the paper Federal Reserve in November 2022. And so what does it mean for investors? That means is at least in the near term, that will be equity will be doing better, and including the US and not just China. And for China, and we last year in the third and fourth quarter, and we told our investor that our preference would be on those infrastructure and energy related kind of a stock, and mainly because at that time the growth, the other sectors were very slow and in contraction in some industry, and then is infrastructure and so on were the sector that have the tailwind, the support from the government policy last year. And but moving on to this year, especially in the first half, and we think that many of those cyclical industry, because of this recovery in the Chinese economy, they are going to do well and doing better. So we actually prefer moving on to more aggressive and more growth consumer and technology firm. And for detail, and you can also check our consumer and technology firm basket at the social platform for some inspiration. Those are not stock recommendation, but just some ideas is what kind of stocks are available in that area. And next, I will look at this chart, and this chart is the credit expansion cycle in China. And the blue line is the credit impulse. What's credit impulse? Is basically the growth rate in the aggregate credit and also money supply and loan and so on in China as a percentage of GDP, and that's the year-on-year changes of it. and we move it 11 months forward, so that because it's with historically the expansion or the change in this credit impulse have an impact in the economy with a time lag of about 10 to 12 months. So we push it forward for 11 months, and we brought it together with the China's manufacturing PMI. And so you can see what the green line actually already bottom, and then moving up, and then that is and well into 2023, and that would mean that it's likely that the Chinese economy will also rebound and recover well into third quarter of this year. So to sum up, and we have a relaxation of the pandemic control containment policy. We have a more friendly attitude and even support to the property sector, and also to the internet and private enterprises, and also effort attempt to set a relationship on trade with trading partners. And then all this happened at the same time when China's credit expansion cycle has already bottomed and in moving up. So that will have a very positive implication for the Chinese economy and also for the stock market. And just one caveat, and that is a cyclical call, and we are expecting this a cyclical rebound. So stock will do well in the next 1 or 2 quarters in China, but the economic growth may be back to 5 to 5.5%. But overall, for China, is still under some structural reform, and some of those policy changes temporary, at least short term, and going longer term, that there is still emphasis on the state-owned enterprises and so on, and the economic transformation to what the authority call the new development paradigm or new development pattern still in place. So in the longer term, the growth may not be going up to as high growth in the past. So secular growth potential has come down in China, but cyclically is in the rebound and strong recovery, and that spell well for the next half year for the stock market and risk and commodity market as well. And then it's going beyond China, and I know that many investors has been quite negative about Europe over the last few months, and because of the energy crisis and because of the war in Ukraine, Russian invasion in Ukraine, and so on. European equities has been underperformed actually rather long term versus the dollar US market for quite some year. But we think that probably is close to a turning point valuation wise, as European equity has been much cheaper than the US, and you're talking about 12, 13 times multiples versus 17, 18 times multiple, and also the earning growth and over the last 2 years in European company actually has been better than so it's and also one thing, the warm weather and also the stockpile of energy in Europe, crude oil and natural gas has actually helped Europe to get through this winter pretty well, in well shape, and better than market expected. And since investor has been so negative about Europe, and we see possibility that European equity is going to outperform. And also after the Ukraine war, and the European government has been really determined to increase the spending on defense. And many of those countries spending less than 2% of their GDP in national defense. Now they're going to take it up above 2% or even to 3% of the GDP. And a lot of those money will be will turn into revenue of European manufacturing sector. And also, last not the least, and China's reopening will be a very good news for the consumer discretionary industry in Europe, and also for the manufacturing, machinery, and all those industry in Europe. And the European market is much more geared towards the physical world and more on manufacturing industrial than the the intangible industries and sectors in the U.S. Represented in the U.S. major indices. And going back to overall income sector, and even though in China we like the consumer discretionary and technology for a cyclical play, but for longer term, globally speaking, we still overweight commodities and defense stocks. And for the reason that Charles also mentioned at the beginning, we see the tangible world is going to outperform the intangible world. And very lastly, and after we talk about stock and we look at the bond, and because it's giving the large increase in bond yield over the last 12 months, and bonds become more interesting. I know bond did not perform, and the 60/40 portfolio did not perform in the past, but over the last 12 months, while they performed before that, but over the last 12 months they did not perform. But now with the yield much higher and valuation on the stock lower and bond yield higher, and a combination of them is may not be a bad idea, and the bond will start contributing to very decent yield to any portfolio. And on this page, and on the left hand side, upper left hand side, I plot two yield curve. The green one is the of yesterday, and then the beige color one is the one before the November FOMC, the inflection point. After that, yield start coming down. And back in November, December, we recommend we kind to buy bonds, including the longer end, and especially the 5 to 10 years, more than from the middle from the belly to the long end. But given this such a big decline in yield over the last few weeks, and we at the moment we see actually and also the mispricing by the market about the potential of a rate cut in the second half. We think that the Fed's not going to cut. So we actually see more value in the short-term T-bills, and which is like it's a 3 to 5 month T-bills are yielding 4 and 4.7%. We see that is a good value one. Then and then rather than the longer end or even the 2-year in Treasury. I think we can get back to we can extend duration by longer term bond later on during the year, but we have to be patient. At the moment, I think it's some T-bills at 4.7%, very good carry, very good for any portfolio. And then is on the bottom chart, the two at the bottom is on the left hand side is that's the investment grade US corporate bond, and that is saying that it's the investment corporate bond is giving an additional yield of about 1%. And giving, we think that the economy is not going into a recession. Probably, say if for more longer term investors, it's not bad to pick up another 1% for investment grade. But we think that it's not very cheap, and so that's part of if for long term investors that may be something they can do, but that's not. But we have to remind investors is the level is not particularly attractive, and even worse for high yield. At yielding only less than 4% and more than Treasury is not cheap at all. It's rather expensive. So can be patient and wait for a better entry level. But overall, bond is something good to have in the portfolio. And the right hand side, upper left right hand side. Since I overrun a bit already, I'm not going to talk a lot about that. That's the inflation protected securities. Is the yield is 1.3, 1.4 at the moment for the 5-year real yield, and that means is and then is that the principal or redemption value is indexed to inflation. So this is the real yield plus the actual inflation over the life of the security. So if inflation come in above 2-3%, and that means it's 1.3, you have to add back that 2-3%, and that would be a better yield than a nominal bond. If inflation stay at 5%, then this bond will give you more than 6%, and then is that will be better than the nominal bond at the moment. But the key thing, of course, is the inflation. Whether we think that inflation will go down to 2% very soon, or they will stay at a higher level. And also important to note, they are not expensive at the moment. Why I say that? Because it's a 1.5 real yield is at the high end of the range historically, and so it's very the real yield tend to more between 0.5 to 1% rather than at 1.3, 1.4 this kind of level. So there's a tendency, possibly a tendency for them to mean reverse, to come down to lower level. That will also help the value of the bond. And I think I'll stop here and I pass it back to you, Charles.
Okay, thank you, Redmond. So, yeah, I think some very key points there about how the focus is really shifting from US to China, how, getting back potentially to a 60-40 portfolio, or adding some amount of bonds in the portfolio can again make a lot of sense. But I guess you can see my slides again. Now I am back with, yeah, okay, I think it's there now. So as you know, I mean, we are also kind of emphasizing some amount of geographic diversification. Redmond just spoke about how Europe is certainly one great consideration, but we can also take a look closer to home, and the tables have really turned for Asia in 2023. 2023 is practically actually turning out to be a complete mirror image of 2022 so far. So in 2022 we had US growth outpacing China, when China was really mired in zero COVID lockdowns and slowdown of the property sector and crackdown on internet companies, and so a lot of negative news kept flowing in. At the same time, we had high levels of global inflation, central banks tightening policies, and the US dollar was also rising, which is a big headwind to Asian assets, EM assets in more general aspect. But getting into 2023, what we've seen is obviously China has pivoted away from zero COVID faster than expected, and not just that, it's actually trying to fire up on all of its economic levers. Again, as Redmond mentioned, they're trying to improve the property sector. They're also trying to reduce the crackdown on the internet companies and stuff. At the same time, if you look at the global story, the inflation has obviously peaked for now, and central banks are slowing down their tightening. We also have the US dollar reversing. It's weakening now, which takes a lot of pressure off the Asian currencies in particular. And to top it all, we have the Asian markets that are actually trading at a discount to their global peers as well, and compared to their historical valuation levels as well. So I think just worth considering as well, adding some exposure to Asia. I have listed some of the key factors to consider for the major Asian economies here on the right hand side. For instance, South Korea is obviously getting benefited because of the upswing in the semiconductor cycle, the investments that are going towards addressing the repercussions of the US CHIPS Act. If you look at Taiwan, it enjoys a huge geopolitical discount. Indonesia has been one of the outperformers last year, and it continues to be positioned well this year as well because of its large mineral and metal reserves. If you look at Indonesia, it's a big supplier of lithium, nickel, copper, cobalt, anything and everything that actually goes into your EV batteries. And that is obviously in interest these days, not just because of China's reopening, but also as a more structural trend of green transformation that we talked about when you talk about EV adoption and all. As that picks up, these metals will remain in demand, and that means Indonesia could continue to be very interesting in the years to come. Vietnam as well, I've been highlighting a lot to everyone I've been speaking with. It's a big beneficiary of the China plus one strategy of diversification of manufacturing supply chains. So I think that continues. That's something which will also, I think, continue to gain traction in the coming years. India, meanwhile, of course, has been mired by Adani headlines of late, but it still enjoys a strong demographic advantage. Attracting businesses as well, trying to get into manufacturing as well now, which has really not been the big focus over so many years. But I would be a little bit more cautious in India because it's relatively more expensive now from a valuation standpoint. So, just to summarize, things are looking up for Asian equities in 2023, both from a fundamental and a valuation perspective. Although there will be, divergence within the region, but there's a strong breadth in the outperformance that we've seen in Asian equities since the start of this year. Also supported a little bit by improving Asian currency performances, and we do think that these trends could continue for the rest of the year as well. Moving along on FX, so we are potentially looking at a lot of volatility, but most importantly, I think our view is that it will be hard to keep the US dollar lower. It may not go to the highs we've seen last year. So, that was obviously at some very big levels, but there is potentially some room for recovery in the US dollar. So, in the past two cycles, the big US dollar sell offs have usually come from either the Fed providing massive liquidity after some sort of a global crunch or something, but this time the Fed is still tightening. So it's just, I think, premature to expect that the US dollar could continue to go down as it has been since, I think, September or October. The US Treasury has been providing liquidity again recently. That's one reason actually why the dollar is down, and equities have also been on a high. But we think that this liquidity injection will start to run dry in the coming months, and then it will actually drive a liquidity headwind as well. When the U.S. Treasury kind of rebuilds its account, sooner or later they have to do it after they clear up all the debt ceiling mess that they are into right now. Sometime probably in Q1 they will do that. And also, just a point to note here is that USD is not just a yield sensitive, does not just depend on what the Fed is doing, but also it's a very risk sensitive currency. So if we do see a slowdown in corporate profits, fears of an earning recession, so that could again bring back the safe haven appeal of the US dollar as well. The Japanese yen, it certainly looks like it has the potential to outperform. That's because of two reasons. One, we saw at the December Bank of Japan meeting, there was a slight tweak in policy, and then speculations are obviously continuing to build. We are approaching the new chief appointment for the Bank of Japan, and then obviously it is expected that whoever will be appointed is going to be appointed by Kishida, and Kishida, the prime minister, he has an inclination to move away from Abenomics or the policies of low interest rates and a very weak yen that they've been following for years. So that is obviously, that speculation is fueling some interest in the Japanese yen. But even if the BOJ does not shift policy, we know that the global yields are cooling, they're coming off their highs, and the yield spread for the Bank of Japan's, the Japanese government bonds, it doesn't look as bad now as it did last year. So that itself gives some room for the Japanese yen to recover. The euro has been largely stable, but I think there were some concerns that too much hawkishness has been priced in, and we will potentially see some correction on that. And the fiscal outlook for Europe is also more robust than anywhere else, also helped by Chinese demand picking up. It helps Europe more directly than it does the US. So I think that's potentially a tactical opportunity. It will likely remain more steady, but there is this long-term energy risk, and they haven't really dealt with that problem of baseload energy supplies. They could get through the last winter because the winter was not as harsh and they had their supplies built up, but this is a threat that will keep coming back in the years to come. I think Chinese yuan has had a good run, and if we continue to see some more development on this Chinese demand recovery story, and if the Chinese central bank also continues to provide liquidity, I think there may be some more room for strength there. But if you want to look at some of the other China reopening proxies, it could also be the Aussie dollar, or in fact any other commodity exposed EM currencies as well, like the Brazilian real or the Indonesian rupiah or even South African rand particularly. But just be mindful of maybe Aussie dollar if you're talking about, or Canadian dollar. There are risks of correction in the real estate market, because these are markets with a very high proportion of floating rate mortgages. So I think that obviously brings some risks to Aussie dollar, Canadian dollar, and some of the Nordic currencies as well. But again, I think let's switch gears here, and it's over to you now, Jessica.
Wonderful. I'm hoping everyone can see the slides. Any nods? Slides hunky dory, wonderful. Okay, so Saxo, for those that have been with us for a long time, excellent. For those that are new to Saxo, you might not know that we're pretty conservative. And so I just might like you to think about this. But before I pose a question, I wanted you to ask yourselves, how many times did you hear the words disinflationary when the Fed governor, when the Fed chair made the speech last week? Some of you might say to yourselves 11 times. Some of you may say, I don't care. Um, but did you read the quarterly outlook that was released to the market? And did you notice how many times Saxo said the words, we are significantly bullish on commodities? How many times did we say significantly bullish? That's not a trick question. That is probably one of the key takeaways for the quarterly outlook. Saxo is significantly bullish on commodities. We were in 2022, even more so in 2023. A lot of that is on the back of what Sharu and Redmond have covered. We've seen the US dollar and bond yields fall down from their cycle highs, but I guess the proof is not yet in the pudding if they will stay lower. We don't yet know. There's so much going on, but let's wait and see. But the factor of the matter is the commodity super cycle is continuing, and we believe there's a lot more room to run. This basically means we're expecting higher commodity prices, and high commodity prices are here to stay. Last year, you heard us speak about a commodity super cycle. What is that? It's just simply a bullish long uptrend in a super cycle. And to have a super cycle, ladies and gentlemen, you've probably got to think about the key ingredients, and you can see our key ingredient mix bag on the left hand side. And one of the key ingredients, if you will, is a weaker US dollar. And I don't know if you have a look at the best and worst performers of markets and also of equities. But I bet you, if you did, you'll probably recall that 2023 so far, and of course 2022, commodities were the creme de la creme. On the equity side of things, the best performers were in energy. And even more so this year, there was more momentum into commodities. We saw the iron ore price pop up 70% from its low, and the copper price, the aluminium price, also up double digits as well. And that was supported by a lower US dollar. For now, there's a bit of profit taking happening, but we do have lots of ingredients in the pudding. That will see prices higher for longer. A lot of VIPs ask us, but how can there possibly be low supply to necessitate this super cycle? We've got to think about the amount of money or capex that has gone into and can go into this mining sector or the commodity sector. And it's actually been falling since January 2023. A lot of that is for ethical reasons. There's also the largest banks, the largest lending institutions in the world are less likely and have got mandates not to lend to companies who are involved in fossil fuels. And also, it's increasingly hard to even lend to some other mining companies where they're not necessarily ethical. That being said, I just want to think about some of the key metals that we've spoken about. So I threw the words out there, aluminium and copper. I want you to think about this. Why do we think the commodity super cycle, as we've been saying, and Charu said, why are we so bullish on commodities? It's not only because of the EV transformation, but it's more broadly thinking about what is happening across the globe, and that is that the IEA are pushing to be emission free by 2050. So, who is the IEA? Well, they're a group of 30 different countries around the globe, and that includes many developed countries as well. And we've got essentially this basket of countries moving to be carbon neutral. Some countries are also planning to phase out fuel combustion engine sales by 2035. What does that mean? It means that those EV companies like Tesla and those wanting to sell more and more EVs like Ford, VW, GM, and the like, they're going to, you bet your bottom dollar, try and do anything to get more EVs into the market so that they are making revenue. And revenue, we know, revenue growth and share price growth or revenue are one in one, they go hand in hand. So this is what we're seeing at the moment. So essentially, because the globe is needing more EVs. We saw last year VW and Tesla sold out of some of their EV models pretty early on into the market of 2022. And that basically was because they couldn't get their hands on enough supply. So thinking about 2023 and further out for years to come, these EV makers are going to be demanding a lot more raw materials. So cast your eye up to the top. We can see 250 kilograms of aluminium are needed for the average electric vehicle. That's quite considerable, considering the aluminium price is up 20%. And then you think about what's the catalyst, say, for investing in, say, a Ford or a VW who are paying these higher prices. Why wouldn't you, as an investor, perhaps consider thinking about investing in the underlying physical commodities themselves, or indeed some companies who are affiliated in production? So they're just some things to consider. Of course, you've got the lustrous, most famous industrial metal of them all, lithium, and only 10 kgs of lithium are needed for an EV. Copper, 83 kilos. Then you think about copper, why at Saxo, you've probably heard all our head of a commodity strategy speak about copper as being the king of the green metals. So why is that? Because we know it doesn't just go in a fuel cell for a lithium ion battery, but also the bulk of copper demand comes from the building construction sector, ladies and gentlemen. And we all know what's happening in China. It's wonderful to see one of our colleagues from China in the office today. But I guess this more so demonstrates that the Chinese economy is reopening. And we know some of the most stimulus and infrastructure spending is likely to come perhaps in 2023 from China. China is the biggest consumer of copper, but all in all, more broadly, 43% of global copper demand comes from the building construction industry. So these are just some things to think about. And so why do we see copper prices moving higher and underpinning strength in this key commodity? Well, it's because we know, going back to the lack of supply, um, we know that at this rate, because supply is quite inelastic, demand is simply outstripping supply. And this is going to happen, according to Bloomberg, for years to come. In fact, at least till 2040. So we think that this is going to be an investment class for the long term. We saw tech stocks outperform the market over the last 10 years. But indeed, Saxo, as you know, we're quite bullish on commodities, and copper is one of our top 3 most bullish commodities as a house that we're bullish on for the long term. And what we're saying here down the bottom is quite simply supply is expected to be in a deficit for many years to come. In a pictorial format, this is a chart from Ole that he presented. And you can see simply to the right, we still have very low copper supply. Even though we do have some copper supply coming back to the market this year, just think about where the bulk of copper is coming from in the world, and that's from Chile. And Chile have been stricken by some flooding issues. We also saw that in Australia last year with our flooding, and that basically capped output. So yes, there is some supply coming into the market, but it still can't keep up with demand. Again, going back to the notion of supporting higher prices for the long term. I can hear you in your minds thinking about gold. What about gold? So gold, some people think, well, why would I invest in gold if it hasn't generated a good return over the last couple of years? Well, that's a valid question that you ask yourself, but we say this: what if the Fed does what the market does, what the market is thinking, and that is, if the Federal Reserve pauses on rate hikes, what will happen to gold? Where there's a bullish case for this, because if we think about the last 3 times that the Fed paused rate hikes since 2000, we saw a gold rally. So essentially a gold rush. So if you have a look on the far left hand side, there was a 56% upside rally in gold after the Fed paused rate hikes. And then cast your eyes to the far right of the screen, the very recent time the Federal Reserve paused rate hikes and then cut. We saw a 62% rally in gold. Of course, when the Fed moves into a pausing rate hike cycle or pauses on rates, that is also good for equities. But interestingly, for those that don't know, we've crunched the numbers and gold has actually outperformed equities and running to a new peak. Oil. Oils ain't oils for those Australians that are dialing in. It's an odd saying. What is happening in the oil market is this. So we see, not just us at Saxo, over the next quarter, we see prices being somewhat limited. However, we're seeing a real pickup in buying from institutions and other sophisticated investors. And we're also seeing diesel demand strongly pick up. And the reason for that is because for those that aren't traveling, or for those that aren't dialing in from one of our Asian offices, you might not know, but Chinese traffic on roads is up almost 30% from where it was the same time last year. So it's still not back yet, but it is rising significantly. And then another thing is that across the entire Asia Pacific region, diesel demand is rising significantly, and that is because of air traffic picking up considerably. And this is a huge demand driver for oil. And then on the downside, we do have supply being limited. Overnight, we heard from BP saying that that they're essentially their hands are tied and their supply is restricted. And then we also have got OPEC plus that are likely to, we think as a house, OPEC plus, for those that don't know, they're the oil producing nations, and they are likely to potentially cut this year. That's our house view. But all in all, we do see for the longer term that oil demand will hit a new record high while we've got low supply, and just also reflect on the fact that EU has put a embargo on buying Russian supply, and this is the first 5 days that this has occurred. So that's something to consider, and then it goes back into that lack of supply issue. So how do you consider, if you're an investor, if you don't want to say use the various instruments that are available on our platform, if you want to say look at stocks or perhaps other instruments using companies. These are just some of the world's biggest commodity companies, and they're available on Saxo's commodity equity theme basket. And we've spoken a lot about oil and why we likely see higher prices in oil. But what we've seen in oil last year and this year is that the most free cash flow growth and earnings growth and profit growth for that matter came from energy companies. And they not only reduced their debt with their higher earnings, but they also are doing share buybacks as well. And then you go down the line and you can also see some companies that are involved in the soft commodity space. So you've got Mosaic, who are in fertilizers. So that could be an example of a company to look at. And you've, of course, got the world's biggest gold miner, Newmont Corporation, and they were in the news this week for looking at potentially taking over Newcrest Mining, the world's second biggest gold producer. And so going back to that scenario that we were playing out earlier, if gold does charge up 61% this year, if the Fed pauses and then maybe cuts rate hikes like the market thinks, then if gold rallies 61%, you'd think that Saxo's outrageous prediction of gold hitting $3,000 is not that far off. And just lastly from me, for those that are interested in those lithium companies. So we spoke about the clean green metals of the future. So just to reiterate, Saxo, as we said at the beginning, Saxo is significantly bullish, unquote, on green metals. We're bullish on overall commodities, but the most upside we see is in copper, aluminium, and lithium, and this is supported by that push from governments and also the car makers themselves. That effectively means higher prices for copper and lithium and also aluminium. Remember, those three components are all needed for a battery cell as well that goes in an electric vehicle. Australia's biggest lithium company, for those that don't know, is Pilbara Minerals. Pilbara Minerals, and then you've also got Allchem. So these are companies with deals with the likes of Ford, etc. And then you've got another metal that we are quite optimistic on, and that's iron ore. And there's a company called Mineral Resources, and that could be something to consider. Remembering that iron ore companies such as BHP and Rio Tinto report their results to the market next week, and we're expecting some record-breaking profits on the back of the iron ore price jumping 70%. And with that being said, I will hand back to Charu.
Thank you, Jessica. So I think let's just wrap things up here. I don't know if you can just see my last final slide. I think just summarizing things here. It's a tough macro environment. I think we really think that the best way to deal with this is to be diversified instead of having just a US only or a long only portfolio. I think it's probably best to add some bonds like Redmond discussed or some commodities as Jessica mentioned as well. I think this year we are particularly seeing a shift more towards China than the US, at least tactically. In terms of sectors, I think, of course, we can't highlight enough the importance of an exposure to the tangible assets versus the intangibles. So the tangibles will again mean commodities, energy infrastructure, logistics, and the likes. Geographic diversification, again, very relevant this year, be it Europe, be it Asia, be it, China particularly, because that's really the where all the action is, at least for the H1 of this year. Thematically, more long-term exposure to an energy infrastructure theme is still, I think, very interesting, as baseload supplies have to still be ensured, but you can't ignore the focus on renewables, on EVs, on all these green metals that Jessica just talked about as well. So I think that just wraps up the entire conversation we had just now, and let's just jump on to the Q&A now. I think we do have a list of them. Let's see how many we can get to answer today. So the first one is from Michael on what is your outlook on supply demand balance for oil and gas for a 5-year time horizon. I think Jessica did mention that in her presentation, but Jessica, do you want to add anything to what you said specifically for oil and from a 5-year time horizon?
Yeah, I guess another way to put it would be we see that oil is essentially, it's not just us, it's Saxo that are saying that, but you've got OPEC and several other oil bodies saying over the longer term, and even the Australian government's energy body also came out echoing this just 2 days ago. In fact, there's not enough gas and oil to keep up with global demand. And that is till 2026. However, over a 5-year time horizon, I think the fundamentals are not going to change based on the fact that that it's quite hard to get, number one, a drill license for something that is producing fossil fuels. So I hope we've answered that, but I think we can take that off the line, and you can reach out to us on Twitter and we can continue this conversation. But the bottom line is there's no quick fix solution. And some governments see that renewables might potentially kick in by 2026, but I don't know how that's possible, or we don't think that is possible as yet.
Okay, the next one from Dave. The US market has rallied significantly in 2023 based on an early pivot by the Fed. Do you think the market will pull back in the near future should the Fed become more bearish? So, I think in the near future, particularly focusing on that, the Fed will only become more bearish if there is a serious threat to the economy. That's my view. I mean, I don't see how, like I said in my showed in my chart as well. I think Fed is really cautious of easing prematurely because inflation, although has come down from the peak, first it's way above their target 2%, and we don't see it getting there in the next 2 years. And secondly, if they do start to cut rates now, there is a risk that inflation could go back up again as well. So I think that really is the focus for the Fed. Now, how will that focus shift away from inflation to easing policy will only be because of a severe recession. And if that happens, I don't see the reason for the US market to rally. The S&P 500, the PE is still trading at a premium to its 25-year average. So in a recessionary scenario, I don't think that justifies, that premium is justified. So I think that there will potentially be, there's tactical opportunity in the markets. We don't deny that. But I think from an overall, the structural perspective or a long-term perspective, the inflation being really the monster that it is, there's potentially more pain to come in the US market still. Okay, moving on to the next one. Do you expect to have more stable policies towards its, I think this is for China, Redmond, so this one's for you. Do you expect to have more stable policies towards its major tech firms, Baba? If so, why? What has changed?
Yeah, I think I can borrow the term transitionary. I mean, in China, I think is still the mentality is still red light, green light towards the private sector, even though they have omitted using that terms in the recent documents. But because now you're using the Chinese companies' terms, is now the primary contradiction in the society is actually economic growth. They want to bring up the growth and also the stability. So in the meantime, cracking down or controlling what they call the disorderly expansion of private capital is secondary. So in order for the tech company to help to create jobs and to boost the economy, also bring back confidence from overseas investors, and also not only overseas but also private entrepreneurs in China, within China, and they have to bring back their confidence and get them to work to improve the economy. So in near term, at least for this year, I think they will be rather conciliatory and they will be using a more soft touch approach, and they may do it more according to the regulation and laws rather than the more discretionary approach like in the past. But once the economy gets to its feet and the overall the approach of not to allow the internet or platform company to become too powerful, too dominant, is still there. So I think it's like after the initial rally. But one thing, just two more point. One point is because it's many overseas investors underweight. China still massive underweight, especially mutual fund. And so those is a popular name if we continue to benefit from them because it's and just a lot inflow into them, and also the policy become more friendly at least for this year. But towards the end of this year, probably it's more meaningful to move to smaller companies, smaller emerging tech company, which with the policy support from the government, like the little giant, and but when the market is coming back from this low point and we go for the more liquid, bigger name and higher beta name. But going forward, those little giant or medium or even state-owned tech company and that have the policy tailwind and support will be something to consider towards the end of this year.
Okay, there's another one for you, Redmond, about so someone saying that they've heard that as a result of the COVID lockdown, there's a reduction of the US dollar reserves. Well, I don't think that's only because of COVID lockdown. They are intentionally trying to obviously reduce their dependence on the US dollar as a reserve currency as well. But okay, I will leave that to Redmond to answer. If this is true, will China fill this gap by exporting discounted goods, and will that be deflationary to the West?
Yeah, in China, still very mindful for keeping its US dollar reserve is more or less above 3 trillion US dollar. And yet they will diversify into just like they have been buying gold, but gold is still too small for China's reserve. So they will keep buying gold, but it's very in near term, it's very difficult for them to diversify a lot from the US dollar. So they will, and of course they don't want to see the reserve going down very fast. So, but I think but at the moment it's manageable. It's not really capital outflow. It's not really to the point that it's become a problem or any top consideration for them. So. So I think yeah, I mean it's the and also when in fact yeah, I mean there's also another drain possible for you. Just one thing, yeah, because the reopening will be maybe okay when the economy doing better, maybe the supply chain improve, they will be doing more export, that will be some more direct info. But at the same time, China will import more services from overseas. So in like travel and so on. So yes, there is some pressure on capital outflow even with the reopening. And even maybe even more, you consider many people will be try to would like to travel outside of China after this 2 years of lockdown. So yeah, and but having said that, I mean that the decline is not so alarming at the moment, and so probably it's not a priority concern or any primary concern for the Chinese authorities at the moment.
And probably it can't move the needle on the US inflation as well, I guess, given the size is insignificant. Is that correct, Redmond? Okay.
For the not so much, yeah. I think yeah. I mean, but goods actually is a deflationary force. I mean, now the U.S. inflation is more on services, and that's much more domestic wages and so mainly related to wages. So.
Yeah, good point. Yeah. Okay, so the next question is on any thoughts on the depth of the European recession versus the US recession? I think we touched upon that as well. So, what was priced in for a European recession was obviously way too extreme compared to the US. But given that they had a softer, a less harsh, I would say, a less harsh winter in 2022, and then of course Chinese reopening benefits Europe more than it does to the US. So that's also bringing some benefits back to Europe. So I think tactically, as I said in my presentation, tactically Europe looks like it is better placed to avoid a recession. For US, it will be a more long-term story. It will come slowly, and if it has to come, even if there will be a slowdown both places, of course, because we've seen this rapid tightening. But Europe has more potential for fiscal stimulus. Europe has, I think that benefit coming in from China's reopening as well. So it can potentially get through this, in much easier than what was priced in last year. The other question is on given the growth, given the global increase in expenditure on defense, can you provide a range of global defense companies that are worth of investment? I think I would really highlight to you here our equity theme baskets. They are available on the platform. If you go into the research tab and go into stocks, you can scroll down to thematic investing and you will find our equity theme baskets there. There's a defense basket. It consists of about 15-20 names of defense companies. It includes Raytheon, Thales, Lockheed Martin, and the likes. It's a global basket. So I think you can look into that and pick up whatever kind of suits your needs and your risk reward settings. And I think we have that for all of our themes. Whatever themes we discussed here today, we have those baskets available on our platform, and you can dig into those baskets and look at what are the components in each of those baskets on the platform. One more on China, or maybe it's on Asia. Given China equities have rallied hard, is it better to look at Asia ex China for more room for outperformance? What I would say is that right now, whatever outperformance we are seeing in MSCI Asia is actually coming because of a lot of China's outperformance. But of course, I mean, this is a tactical opportunity. If you do think you don't want to take up that risk of being invested in China, because of regulations, like Renman mentioned, it's never going to go away. So if you want to stay away from that, then of course you have these other proxies that we highlighted, which could be MSCI Asia ex China, a particular Asian country. It could be some currencies like Aussie dollar, for instance. So it depends, of course, again, what kind of a risk you want to take at this point. But tactically speaking, China looks like it can still provide the best returns. But structurally speaking, the story is a little bit different.
I could just add something to that as well. As we mentioned in the quarterly outlook, we also referred to the Bloomberg Commodity Index, and I'm just covering off one of the questions here as well that moves to commodity ETFs. So we do have a forecast for the Bloomberg Commodity Index to rally up 10% this year. That might not seem like much, but remember that tracks 23 of the major commodities. And obviously in those particular subsectors of the commodity basket, which we've covered today, you could potentially get more outperformance if you so wish. That's something to consider.
Yeah, absolutely. The other question from Paul: China's reopening is clearly good for growth, but much has changed since pre-COVID times. Even if there's expected overall growth out of China, it's not likely to be as efficient as before, both domestically and in cooperation with international cycles. Is it possible that optimism over China's reopening and its impact on global growth is badly misplaced? Redmond.
I think the question has certain, it's a truth in it as well. I think about under whether actually we agree in the more medium to longer term. And I think you also mentioned in our what we've just discussed is that China secularly, it's no longer a high growth country given the declining working age population, and also now is still in the process of transforming the economy, and then but cyclically, because of those relaxation of policy, the pent-up demand, and also there's the expansion of credit cycle, and this is a cyclical upturn for 2-3 quarters. But structurally, yes, China probably go back to even be below 5% growth in the more medium term, 3 to 4% growth, and that is emerging market or other Asian economy may be even more interesting for a longer term point of view. But at the moment, and is especially given underweight position, and China is interesting place to put your money in. And then is the demand for commodities will also bring is a good news for in the commodity company, energy companies in other market, and that might be a little bit contributing to some disinflationary pressure to goods manufacture the goods, but that's on the other hand, inflationary pressure on commodities, and also will not affect, as we discussed, will not affect the U.S. inflation on the services side.
Okay, the next one is actually directly on commodities. We talk about a commodity super cycle, but commodity ETFs are off 25%. What is the disconnect here? Jessica.
Good question.
Yeah.
So we've been speaking about, so I think you've got to consider firstly which ETFs you're actually looking at. That's really hugely important. And that's why at Saxo, I guess we put together the baskets, because when you're investing in an ETF, you really need to click on the allocation to see what is the composition of that ETF. So some ETFs, you're investing in commodities, and some are diversified, way overly exposed to oil. Some, for example, have got more so larger components of iron ore and copper vis-a-vis the typically ETFs that invest in the big miners like BHP and Rio Tinto and Fortescue Metals. So I'm not sure what commodity ETF you are in. If you're in the Bloomberg Commodity Index, the reason that it would be significantly lower if you're investing in an ETF that's a proxy of that index, then the reason would be the pullback in the oil price. However, if you are in a commodity company ETF, like say a QRE, for example, then your portfolio would be significantly up. And then if I think about a QRE type of ETF, I mean, that's actually up 32%. So you really need to pay strong attention to the underlying components of an ETF before you invest. So that's some takeaway free lunch advice for you.
Yeah, great point. And we've actually also seen much more divergence in commodities this year compared to last, where industrial metals are outperforming. Energy is broadly stable, despite obviously China reopening, because there's just way too many factors playing in there, and the food thankfully has been relatively lower as well. So last year everything was up, and that was driven by the Russian invasion, and because they could not, they did not send the crops, they did not send the oil or the gas or whatever. So it was a very broad-based outperformance in the commodities. Whereas this year you could potentially see some divergence. So to Jessica's point, it is even more important to be able to choose the right commodity ETFs with the kind of exposure that you are looking for, really. Okay, the next question from Paul is on the Russian invasion of Ukraine took most of the world by shock, and this has had a large economic impact. If the Russian war escalated to other European fronts, or if China becomes militarily active in the region, would commodities still look as desirable from a defensive investment point of view? More so, I would think. But Jessica, what's your take?
That's a really good question. I think we go back to what you said. So there's many different commodities, so we need to take a secular approach. So if there was an invasion, let's say in countries hunkered down, like what happened with Ukraine. I mean, you couldn't get any cargoes in or out of anywhere. Um, then that was a significant upside risk for wheat, and then that put price pressures on energy commodities because there was a lack of supply there, and then other industrial metals like iron ore and aluminium as well were pressured higher. But it completely depends. I mean, playing devil's advocate, what about, I don't know, Russia, China? They're completely different regions. But I would just say, if there was a horrible situation and countries went back into lockdown again, I'm not saying that this question is about COVID, but you just have to think about that. Commodities are cyclical. So that means they typically do well when growth is high. So what would happen if people were bunkering down in their homes and there was an actual invasion, or the war escalated, or a war escalated? Then that wouldn't necessarily be a good thing, because there would be limited people on the streets. So there's so many different ways that you can think about that scenario. I don't know. What do you guys think?
I think also, like, what happened with the Russian invasion, the supplies are falling short, and there are some basic energy needs that are, just not discretionary. That, you need them for your day to day, just to, just the switching on the heat in your houses, or, running your manufacturing supply bases. Hopefully they still keep running. I mean, hopefully the situation doesn't come for the first place. But I do think that the impact on the supply will also be a lot more. So I would still think that they could remain a bit supported, for the commodities. Yeah. So the next one, Jessica, someone's asking, no SFR. I think it was referring to your list of Australian resources companies.
Yeah, great question. So I should also point out, across our entire Saxo equity basket themes, we typically put in stocks in there that are sorted by market cap. So if you have a look at Saxo's broad commodity theme basket, stocks in there have purely got in there if they're pure play commodity companies, and also the bulk of their money is from commodities, and they're sorted by market cap. Down under in Australia, it's by market cap. So no SFR, just because it's not one of Australia's biggest. So Sandfire Resources, good question. Let's say if it picks up in market cap over the next few years, or even next year, then it would jump in, or it would jump in.
Great. One on bonds for you, Edmund. Given your suggestion that inflation will remain elevated and the possibility of more Fed rate hikes, how much duration risk with bonds would you recommend?
Currently, actually, I don't want to take a lot of duration risk. As I said in my presentation, I find T-bills actually quite interesting, and even on tips, the 5 year the duration for a 5 year tip is only 2.2, I think currently. So yeah, I don't really like duration at this pricing, but once the market price out the rate cut in the for the second half years, and when yield become more reasonable, bounce 50, 75 basis point from here in the 10 year, and that will become more interesting with a high level. The yield is still a high level. One thing I think is as Saxo, we think that is the Fed is not going to be very aggressive from here, because they cannot allow the actually, because as we put it in this in our Q1 outlook, is the fiscal side is going to be dominant, and because of given the huge financial the fiscal deficit, and if at 4-5% or 4% yield is still okay, manageable, but when yield much high, but the Fed have to have the nominal growth higher than the growth in the deficit. So in order to reduce not to let the deficit to be out of control. So in order to have nominal growth to be higher than the growth in deficit, if you don't have a real growth very high, then you probably cannot. You are not really want to push down inflation too aggressively. So and giving yield too high. So I think yield pretty much is at 4%, 5% level, and when you get back there, it would be very interesting and to add a lot more duration. But at the current level, we find that it's a bit too expensive. So I would rather stay on the short term. Yeah.
Great. There's one from Ben he's saying that on the Saxo Market Call podcast, Peter Ganvi said that I find China not very interesting due to corporate governance and government. Is this the view of Saxo? I think we already touched upon that. Tactically, it's a great opportunity. Structurally, there are risks of regulation, of cyclical growth slowing down as well. China's growth is structurally slowing down. So I think let's just move on to the next one. It says a strong US jobs report last week. Is it a short term or a seasonal? I would not read too much from 1 month of report. Of course, that goes without saying that the labor market in the US is extremely tight. So the labor supply is structurally slowing down. So I think whether it's a 500K number, unless it obviously repeats in the next few reports also, or even if it was 200, for me, the reading was the same. The labor market in the US is still tight, and that still continue to feeds into inflationary pressures, and the Fed has to keep rates higher for longer. This one for Jessica. For commodities investing, how would you recommend balancing oil, gold, and others? And how many % of one's overall portfolio do you recommend to be allocated to commodities?
That sounds like a financial advice question to me. We wouldn't be able to stipulate, but right. So what we do advocate at Saxo is diversification. And the reason that we advocate for diversification is because over time, a diversified portfolio has typically outperformed one that's just exposed to a certain sector. Example, the S&P 500 or the ASX 200. And that's if you look over the last 10 years. That's historically speaking. So then if you think about investing in those commodities, if it was me, I might take a diversified approach. I think you've got to think about our view on Saxo is that inflation will probably pick up later on in the year, and with that being said, that might potentially mean that oil prices kind of are range bound for now and then pick up later on in the year. But we do see higher oil prices, to answer your question. We do see higher lithium, higher aluminium, higher copper prices. The key catalyst is looking at the US dollar. A higher US dollar typically means lower commodity prices. So So always we're watching the US dollar very closely, and that is where we get our lead from. And you've got to remember why commodity prices recently pared back recently, and that's because the US dollar reared its head again. So that's something that we consider. But over the longer term, yes, we're bullish because demand is outstripping supply. There's not enough supply. However, the next big catalyst for that super cycle to kick off would be again for the US dollar to roll over. For a US dollar to roll over, we need the Fed to basically take their foot off the gas. But this week, last week, we've heard more hawkish remarks. So let's have to play a wait and see, and just keep following Saxo because we provide daily commentary on that, and that should help guide you.
The last one for you, Jessica. What's the view on uranium? I think we did publish that in our last Outlook, was it? Correct me if I'm wrong. Q4
Yeah,
Outlook?
yeah.
Yeah.
Good point. Yeah, we do. Yeah, we put together a basket that you can refer to of the world's biggest uranium commodities companies that you can look at. Bear in mind that a lot of uranium companies, um, a lot of them don't actually produce money. We advocate for going to the larger end of town. Reason being is because they're the ones that can ride out the market storms with high interest rates. Because the jury's not out, we don't really see the Federal Reserve pausing rates anytime soon. So that means you might potentially find more upside in those larger companies that are able to pay high interest rates while riding out the storm. So again, please do have a look at that basket. Maybe look at the larger names that are on the list.
Great. I think we'll have to wrap it up here. We do have some more questions, but we'll probably, expect you to kind of reach out to us. I'm sure you can you can get our contacts from the website, or just from one of your relationship managers if you have one. But I think I would just end it here by saying thank you very much for joining this call today and this intense Q&A session as well. I think we had a great time chatting, and I think thank you very much. Have a good day ahead. Bye. Bye, everyone.
Thank you, everyone. Take care.